Thank you very much, David, for inviting me today. The first 1,000-point down day in a couple of years in the S&P 500 and the Dow Jones. So we have a lot to talk about. A lot of my worst case scenario targets on the downside that I made on Friday, they came true today, intraday, and we were in there covering shorts and buying longs. That's me at the USS Constitution at the Boston Navy Yard, which is a very important place in the history of the U.S. Marine Corps, which I am a member of. So let's go flying a little bit first. I have been in the market now for 53 years. I started out trading when I was in the early 70s, working for a Japanese brokerage house, then 10 years working for Morgan Stanley, setting up their international department, a little brief time out in the US Marine Corps in Desert Storm, then 10 years running a dedicated hedge fund, and now 15 years publishing the Diary of a Mad Hedge Fund Trader. We specialize in global long short strategies. We were up 90%, that's 90% in 2021, and we are up 10% so far in 2022. We saw this meltdown coming from a mile off, and the subscribers so far are extremely happy. So let's move on here. This is our monthly performance for the last 12 months. Here we are, January midday, we were up 8.42%, up 90.02% for all of 2021, 512% since inception. And we have a 93% success rate on our trade alerts. We send out about 300 a year. This is our current portfolio. Notice that we are short, the triple short, the TLT, which is the United States Treasury Bond Fund. We had an early short in Microsoft, in the S&P 500, and a short in Apple. Those have been spectacular money makers just in the last week. Total aggregate position, 90%. Everything goes our way. Our expiration value in February will be up 16.78% on the year, which is not a bad way to start a year. Here's our trailing one-year return, 87.85%. And this is our 13-year return, averaging 42.83% since inception. That's about double the S&P 500. So there is a method to my madness, believe it or not. This is going to be another barbell year where part of the time tech goes up, part of the time financials and industrials go back up, and your ability to rotate back and forth between the two sectors will determine whether you will make a lot of money this year or lose a lot of money, as a lot of people are finding out, because they started this year mistakenly way overweight technology stocks. Core short in the bond market will be key, but you want to trade this too. Bonds saw another repeat of the year ago $20 crash as hedge funds added new positions for 2022. Omicron is 3 times more contagious, but 1/3 as fatal, meaning the peak could be here or maybe even took place last week. Bitcoin goes dead in the face of rising interest rates. Non-yielding instruments do terrible during times of rising interest rates. VIX over 30 is the ideal long position, and we actually saw a VIX today just short of the 39 level. We started covering shorts and adding longs right when we hit that level. First Fed rate hike in 5 years has been moved up to June or even March, triggering a 10% correction in the stock market. And while the first 4 of those rate rises are already discounted in the market, the next 8 aren't. Yes, I'm looking for 12 interest rate hikes over the next 3 years. These are COVID cases. We hit well over 1 million last week. I expect them to go to near 0 by the summer, and that will be a major stimulus for an economic recovery and the stock market. This was our peak cases a year ago in COVID, and it looked really bad then with major concentrations in the South and the East. This is last week. It just doesn't get any worse than this. Virtually every county in the country is at a maximum level of COVID cases. So it only gets better from here. That's why I'm looking for such a sharp decline in COVID cases. U.S. economy is going from strength to strength. Two COVID variant-induced mini recessions in 2021 will be followed by an historically strong 2022. Growth will downshift from 7% last year to 5% this year, but it's still a blockbuster number. If COVID disappears by summer, the label shortages will disappear. One threat will be the end of supply chain problems, which will result in over orders getting delivered and future orders cut back. Big question for traders is how much of this is 2022 growth is already priced in during 2021. Right now, as of today, it looks like all of it was. No classical recessions due for several years. And if you want a job, you can get one at the gas station in Incline Village. That sign has been up there for a month. So this is our secret weapon, our Mad Hedge Market Timing Index. And this shows we have farther downside to go. So may get a little rally yet this week, some short covering, but then I'm looking for our index to go down to the 20 level or lower before we actually start aggressively going net long. This is a 3-year record of the Mad Hedge Market Timing Index. And you can see we sold off from a primary high at the end of November, a secondary high at the end of December, and it's been in free fall ever since. So the great thing about our market timing index is we get lots of room for round trips several times a year. This is one of them. Weekly jobless claims was kind of a buzzkill last week, a 4-month high. And I get all my good trading ideas shoveling my car out from snow at Incline Village in Nevada. We got 20 feet of snow in a week. And yes, there is a Tesla hidden in there somewhere. Stocks, what got you there last year won't get you there this year. It's going to be a totally different game. This year we have downside. Major sector rotation took place at the end of November, out of growth tech into financials, industrials, commodities, and value. This could go on for another 5 months. Soaring interest rates up 45 basis points in a week on the 10-year is the major driver. We'll have to work twice as hard to make half as much money in 2022, although it's not turning out to be the case for Mad Hedge Fund Trader because we were able to nail the double top in the market. Look for a weak index in the first half, the strong one in the second half, leaving us up 10% or more on the index on the year, and we will be up anywhere from 50 to 100% on the year. So by every 10% dip, volatility pop over 30, these are your ideal entry points. 2021 and 2020 were characterized by multiple expansion. This year it's going to be all about earnings expansion with tech leading at a 30% annual rate. I'm looking for Dow 240,000 by 2030. That's up about 20 times. And this is just a repeat of previous cycles. Now, it's not some outrageously high forecast. So let's get into the individual charts, and you can see the levels predicted by our market timing index. We saw worst case scenario last week, 422. We got that today. We actually got to 421, and then we bounced hard to close up. Today actually saw the largest intraday upside reversal since 2008 or 13 years ago. So yeah, not a bad place to be covering shorts and buying longs. We were doing that as fast as we could write the alerts today. VIX also went up just short of 39. This is higher than, this is a multi-year high. I think you have to go back to 2020 to get a VIX that high, and even then it was only in the 40s. Dow average bombs away, down nearly 4,000 points in 13 days. How about that for a beginning of the year? Russell 2000, just managed a little fake breakout right here. in November, and it just gave the whole thing back. We're down about 25% from the November highs. NASDAQ, of course, has been the worst of the sell-off, and I had to put up a 3-year chart to actually get relevant numbers on this chart. But we essentially gave back all of last year in 3 weeks. That's exactly what we've done. We've come right back to NASDAQ 13,000, which is where we were a year ago. And we may not take a break on this until we get all the way down to the 200-week moving average down at 10,261. So look for more damage in the technology area, but eventually we are setting up for the entry point of the decade, probably in the next 6 months for technology stocks. Yeah, that's the view from my house. The only way we could get out of the house was jump out of the second story with a shovel and start digging to look for the front door. That is a heck of a lot of snow. So the way to play this game is a barbell portfolio. You want to go 50% into big tech, 50% into domestic recovery, including railroads, couriers, banks, construction, credit cards, event organizers, ticket sales, airlines, and retailers. This has led us for the last 18 months and just gave up its leadership now. So we're looking for new lows in Microsoft. We're short Microsoft. We have the 340, 360 put spread. That's almost at max profit already. We're also short Apple. We're along the 180, 190 put spread in Apple. And again, almost at max profit here. And it looks to be gunning for the 200-day moving average at 147. Google also a complete meltdown here, looking to buy this sometime in the spring. They have one of the only legal monopolies in advertising. Now, Amazon also just completely destroyed, down 1,000 points since November, or almost a third, and looking to buy this on a dip in a few months, definitely not now. Tesla looks like it's doing one of its ritual 45% corrections. We've already done about 35% now, from 1250 down to 850. That was the low today. And again, my long-term target on Tesla is 10,000 in 10 years. NVIDIA, major leader in graphics cards, again, having a huge meltdown here, already given up the third, looking for lower lows, but it's an extreme long-term buy. And Palo Alto Networks, hacking never goes out of fashion, looking to buy around the 200-day moving average around here. AMD also slaughtered 165 down to 118, and also looking for a buy in the spring. Salesforce already slaughtered to 310 down to 200, looking to buy this massive online Salesforce tool on an extreme sell-off. And Adobe, same thing, looking to buy the dip here. We've gone from 700 to 500, another buy on the dip stock. Notice the roads were all closed up there at Tahoe. I was the first car in about 1,000 trying to get back into Incline Village. No passing is allowed. Second half of the barbell, bets on a domestic recovery. Upside potential for domestics is greater than it is for tech. Some of these stocks have not moved for 5 or 10 years. Focuses on economically sensitive cyclical industries. Makes a great counterweight to high growth technology stocks. We could spend all of the next year rotating back and forth between value and growth. Boeing looking for a major recovery here once the Chinese start buying their planes again, which will be pretty soon. UPS also does well in any economic recovery, looking to buy the dips here. Caterpillar looking for the passage of an infrastructure bill sometime in the future, a recovery of real estate in China, and massive construction boom going on in the US. And Walt Disney, this is going to be your high quality recovery post-pandemic play. Parks are only operating at 50% capacity now. When they go back to 100%, then you will have a huge performance in this stock, probably back to about the 200 level, got down to the low 130s today. So great value already setting up for some of these domestic recovery plays. Industrials look to bottom out shortly and go on to new highs. U.S. steel will be a front runner there. And of course, any economic recovery uses tons of steel by the dip. This is the first time since the pandemic began that you've been able to buy U.S. steel in the teens. Union Pacific, any recovery means moving lots of stuff. So again, look to buy Union Pacific on this dip. This is also a recovery of trade with China play, since they are the largest east-west railroad in the country. Delta Airlines, airlines are getting ready for another massive recovery once the pandemic ends and people can go back to flying domestically, and the airlines can get the crews to fly the planes. That is the big problem right now. Transports also looking for another big, this is a basket of other transports and airlines. Healthcare happens to be the cheapest sector in the market. They got completely creamed with the end of the pandemic. The next move will be driven by more traditional medicines like cancer cures, diabetes, and so on. It goes back, it's back to normal for the healthcare industry and back to high growth. Amgen's been one of our favorites. I was involved in the foundation of this company 40 years ago, and still looking to buy this on a dip. Goldman Sachs got slaughtered for fears of a bear market that leads to shrinking value. What happens when the bear market doesn't happen? It turns out to be just a correction. Answer: Goldman Sachs goes rocketing right back to the highs that we saw in November. And Morgan Stanley, same deal. Love working there for 10 years, and I see the stock going to new all-time highs in the next few months. JP Morgan Chase, big earnings disappointment, fire sale on the stock, looking to start buying long-term positions here. Same with Bank of America, same with the metals area. You consume massive amounts of metals in any economic recovery. All these are for sale right now. And BlackRock, rising interest rates means higher management fees for asset managers. We've been involved in this for a couple of years, and I am looking to buy this one also on a dip. Berkshire Hathaway is a natural barbell. It has heavy weightings in Apple. It's the largest single owner of Apple shares, and it also has a major exposure in banks. Just had a giant 25% move on the stock since the beginning of December. Look to buy this on a dip. Emerging markets. If Europe raises interest rates faster than the US, which is definitely a possibility, that means the dollar becomes weak and European currencies are strong. And when that happens, you want to buy emerging markets with both hands. So this seems to be setting up for a major buy. So again, emerging markets, probably your first pick, your high volatility play right there. Here's trying to drive around Lake Tahoe, and again, driving is tricky to say the least, especially when you have 10-foot drifts on both sides of the road. Bonds have been our biggest trade of the year. We have been aggressively shorting the bond market for the last 6 months, really, and it really started to pay down big time just this month. Omicron peak brings anticipation of economic recovery and a spike in interest rates. We're actually down $16 now from the top in the TLT. The Fed is fanning the flames by ending QE and promising 3 interest rate hikes, make that 4, and actually make it 12 over the next 3 years. So much higher interest rates mean much lower bond prices. The final bond auctions of 2021 were a disaster. Bond funds had their worst year in 40 years, and this year looks to be worse still. Look for 2.5% on the 10-year by the end of the year. TLT could drop from 180 in the pandemic high in 2020 all the way to 105 by 2023. That looks like a great short to me. And boy, has it been a great short. 155 to 140. Yeah, I'll take that all day long, especially when you're triple short the bond market. So yeah, big earner for us. And this could go on for many more months. 10-year treasury yields got up to 175, looking for 2.5% by the end of the year. And of course, if you don't do ETFs or options, you can always buy the TVT, which is a 2x short treasury bond fund, and that has already risen 25% since the beginning of December. Foreign currency, slowing rate of interest rate rises in the US means a fading dollar. With inflation in Europe at 5% is lit a fire under all currencies as their interest rates are rising faster than ours. Buy the rumors, sell the news, profit taking has hit the US. China posts a record trade surplus at $676 billion. Currency with the fastest appreciating interest rate always rises the fastest. Long-term fundamentals for the US dollar are still poor, with a $33 trillion national debt by the end of this year. Here's the Japanese yen putting in a head and shoulders bottom, looking for a buy. Euro, same thing, putting in a very major long-term bottom, looking for a buy here. And the same with the British pound, which has already taken off and hit 200-day resistance. Australian dollar is our favorite because they're going to see huge benefits from a massive increase in prices in the commodities they export. So again, looking for the Australian dollar to go to 1-to-1 against the US dollar compared to a current level of only 71. Yeah, giant icicles coming out the window in one of the greatest storms in history. Beautiful to look at. Bitcoin, absolute destruction, down 20% in the last 2 trading days. We actually hit a low today, intraday, of 33,000. That's down from 69,000 in November. Ethereum has done more than a 50% decline. Any non-interest-bearing instrument gets punished when rate rises, and crypto is no exception. Omicron variant delivered a new mini recession, and crypto is no place to hide. Will this be a 50% correction or an 80% one, as seen in years past? Looking more like the latter these days. Long-term buy in Bitcoin signal, long-term buy signal for Bitcoin is still intact, but we may have to see lower lows first. Here is the Bitcoin chart. We gave up all of last year's gains. We're just above 30,000 at today's lows. My bet is that we hold here or at 28,000. Then you want to pile back into this for a move to 100,000. Same with Ethereum, down 65%. I'm looking for a bottom right around the $15 level, and then we take off for 50 and then 100. MicroStrategy is down nearly 75% from its highs a year ago. That is your leverage long play for Bitcoin. And the same with Block, another call option on the global mining industry. Yeah, that's me at my Lake Tahoe house. I just sit there all day in front of the fire and think great thoughts and send you trade alerts. Energy looking for higher highs. Lofty US GDP forecasts are sending oil to new highs. A hot 8.1% growth rate from China, the world's largest consumer, is another major factor. $100 a barrel oil is possible, but with rising volatility. Saudis want to keep Texas tea under $100 a barrel, otherwise it destroys the value of their US investments with the stock market crash. End of oil is upon us, but it may take 30 years to unwind the existing infrastructure. Avoid all energy plays like the plague. Here's oil, looking for that $100 number, but with high volatility. It's just a matter of time before the entire US car fleet goes electric. Here's USO, same chart. Energy Select are the big energy stocks, including ExxonMobil, Chevron, Schlumberger, Kinder Morgan, and so on. They've just had a great run. I'm looking to buy the dips for a short-term trade only. Halliburton, same deal. Nat gas is the only carbon area that looks interesting from a medium point of view, because number one, it's cheap. Number two, we're having a horrible winter. Number three, nat gas produces only half the carbon that burning oil or coal does. And if you have to pick one carbon source, it will be natural gas. Therefore, the natural gas-fired plants will be the last ones to be shut down. So looking for a major doubling by the end of the year in natural gas. UNG is the ETF to play there, but watch out for the contango. It can be ferocious. Precious metals, no trade yet. Not a hint of downside protection offered by gold in this global sell-off. Gold has been the worst performing asset of 2021, provided absolutely no downside protection during the pandemic crash. If 9 trillion investment decamps for the crypto world, leaving only jewelry demand, 9 trillion could go out of gold into Bitcoin. Rising interest rates bode poorly for precious metals as it raises opportunity costs of non-yielding assets. Bitcoin is clearly sucking capital out of precious metals. Stay away until this plays out. Silver is the better play because you have actual industrial demand there. Here's gold, and this is a 3-year chart, and we've had a coil going on here for all of 2021. I expect eventually we do get some kind of upside breakout, but clearly the answer is not yet. Silver looks a lot healthier, having made multiple bottoms down here at the $19 level. So looking for higher highs on silver. Copper, again, that I expect to see much higher highs because every electric car needs 200 pounds of copper, and annual car production in EVs is going from 1 million a year last year to 25 million in the next 10 years. That is one heck of a lot of copper. There are not enough mines in the world to supply it. So prices will have to go up. Real estate, no rest for the weary. It just goes from hotter to hot. I checked the market last week in Reno, Nevada. There are 8 houses for sale between $500,000 and $1 million in the entire city. You cannot buy or rent anything in Reno on pain of death. Prices are continuing to appreciate, but that'll slow down. We may do a third of last year's 18% rate, and rents are now rising faster than home prices because people can't afford to buy. Here's the S&P Case-Shiller National Home Price Index, up 18.4% for October. Phoenix, Tampa, and Miami are leading with spectacular numbers. Crown Castle International, one of our favorite yield plays. They make 5G cell phone towers, and right around here, you should have about a 3.5% dividend yield. U.S. home construction endurance slaughtered because of the fear of rising interest rates. Watch for a double bottom right around the 66 level. So this is my other home in San Francisco. That's my view. I'm out there every evening hiking with my 50-pound pack, and I never get tired of looking at these West Coast sunsets. So what do we do about all this? Well, stocks, you want to buy dips aggressively once the meltdown finishes. Bonds, keep selling rallies aggressively. Bonds are probably in a bear market that'll last 10 years or more. Commodities, you want to buy the dips for an economic recovery. Currencies, you want to sell short dollars, buy the euro and the Aussie. Precious metals, stand aside, wait for the upside breakout in gold, buy silver on dips. and energy buy the dips, but only the big ones. The target there is $100 a barrel. Volatility short over 30, and we actually almost hit 39 today. That would have been a great short candidate for the VIX. Made it all the way back to 34 by the close. Real estate, buy dips, Bitcoin, stand aside and let it find its own way. So today I'm offering a special deal on my Mad Hedge Global Trading Dispatch service. With it, you get instant trade alerts sent out at market sweet spots, about 200 to 300 a year, and all the reasons to execute them. You get live bi-weekly strategy webinars like this one with an interactive Q&A. You get special reports on urgent investment topics, invitations to strategy luncheons around the world. Once the pandemic ends, I used to do about 25 of these around the world, more educational videos and webinars than you can consume in a lifetime, and access to a 14-year database on investment ideas, searchable by names and ticker symbols. I'll even give you the name of a good surfing school in North Africa. Warning, it's a lot harder than it looks. This is the one-stop shop. It's for individuals who want to understand what is happening with their retirement funds. It's for people who will learn how to trade for a living, get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford an in-house research department. Get in while the melt-up is on. With that service, you get my Global Trading Dispatch. That is a daily letter giving you the key investment themes in the market and what you should do about it. You also get my Mad Hedge Hot Tips, the 5 most important things that happened today and what you should do about them. This is what I'm not going to charge you for the service. I'm not going to charge you $100,000. And that's what I charge my big hedge fund clients. And they're happy to pay because I make them millions of dollars. And I'm not going to charge you $10,000 for this service. That's what I charge my concierge clients who get my personal cell phone number so I can act as their investment 911. And I'm not going to charge you $3,000. That's the full price on our website. And I'm happy to take that price if you want to pay it. But today, thanks to my friend David Kosmitter, you're going to get a special deal. Creating this product cost me millions of dollars. Running it cost me millions more. It is the best trade alert service in the industry, bar none. So I'm offering you today 6 months for just $997. That's a 66% discount to our website price. Only available through this webinar today, right now. It's a limited time offer. I can only take 25 new subscribers at a time. So it's first come, first serve. I can't wait to make you a top drawer trader, and click on the link in the chat box on the right. And David, do you have that?
No, I never received that.
Okay. Well, I have it on the last page of the PowerPoint, and look for emails from Doug, and the link will be there. But if you can somehow cut and paste from my PowerPoint, then you can also get the link. Let me make the money for you to pay for your subscription. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. And David will get you that link shortly. 6 months for just $997. Let me show you how to make the money for you to pay for your own subscription. Buy now and you will instantly receive a trade alert with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. Don't leave good money on the table. 95% of these trade alerts make money. This is the chart for the trade alert that I am about to send the new subscribers. I'm not going to tell you whether it's a buy or a sell. Maybe you can guess by looking at the chart. but I've been making a ton of money off of this in the last year. So David, here is the link to the sales page. Can you copy that?
Yeah, I got it.
www.madhedgefundtrader.com/STE35 Sierra Tango Echo 35. Go ahead and put that in the chat box.
Yeah, that's in the chat now.
Okay, yeah, I can't see the chat box, so let's see. Let's see. Let me look at all the chat. There it is. I now have a chat box. So let's go flying again. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars. And I promise not to tell who. So it was in that spirit that I made my way down to the famed beachside community of Malibu to meet long-term Mad Hedge follower Richard Zeiler. Richard is a man after my own heart, plowing his millions in trading profits into a ground-up restoration of a 1929 Travelair D4D biplane. This particular plane is quite famous because it was featured in a 1930 war movie, Hell's Angels, which won a Best Picture Academy Award. However, Richard had to buy 20 other Travelairs to get the parts he needed to return this 100-year-old plane to flying condition. You can see there I am flying the plane, buzzing the surfers at Malibu. The modernized plane has a 300 horsepower engine and flies 550 miles in 5 hours. Since I'm one of the few living tailwheel qualified pilots left in America, Richard was happy to let me have the plane for an afternoon where me and my kids buzz the surfers on the California coast. Let me make millions of dollars for you as well as I have done for thousands of other followers over the last 14 years. I look forward to working with all of you. And by the way, if you want to ask questions about any specific stocks or asset class, just go ahead and type them in the chat box. Now that I can see it, I will be happy to take your questions. Okay, so there's the offer, 6 months for just $997, free instant trade alert. You also get a free forecast report for how stocks will play out for the rest of 2022. Okay, so let me take a look at some questions here. Here's one. Do your trade alerts cover only stocks, or do you also do options? And the answer is every trade alert we send out has a recommendation for both a stock, a bond, and an ETF. That way you can tailor every trade alert to meet your own specific risk tolerance and experience level. Okay. Here's another question. Will the election in November have any impact on the stock market? Probably not until October. Stock markets really don't care much about elections. They only get involved at the last minute, and then you get some volatility. The big volatility usually comes after elections, and that's how you can make a lot of money, is positioning yourself beforehand. Here's another question from Danny. What about bonds medium term? Answer: bond prices down, yields up. We're looking for bonds to go down for the next several years, maybe even 10 years. The current yield on a 10-year Treasury bond is 1.75%. The last peak prior to the 08 financial crisis was 6.5% on the 10-year Treasury bond. That would take the TLT from today's 144 all the way down to about 60. 60 in the TLT. So yeah, there's your 10-year view. And I've seen it happen before. I was trading in the markets when we actually saw a 10-year yield of 12%. Okay, any other questions here? Let me check and see if any orders have come through. Just want to check my email here. And anybody else who wants to ask questions, go ahead and type them in, and I will get to you in a second. Okay. We have had quite a few orders come in. Let me take a look and see who to thank. Okay, we have Wilson from Enterprise, Mississippi. Thank you very much, Wilson. Promise to work hard for your money. It'll be a pleasure to work with you. We have Frank from Columbus, Iowa, has come through. Thank you, Frank. We've had Tracy from Grand Junction, Colorado, just by. Well done, Tracy. Your trade alert should be in your inbox, and you should be able to execute first thing tomorrow morning. And prices are not too far off what I recommended in the trade alert. Okay, we have another one, Judy from Memphis, Tennessee. Welcome to the club, Judy. Best investment decision you ever made. And we have Karen in Cody, Wyoming, getting lots of female subscribers who often turn out to be great traders. Okay, here's another one from another question. Which option strategies do you send alerts on? We give people the choices between buying outright puts and calls. We actually make a lot more money with call spreads and put spreads. And when we hit these generational lows or highs in prices, then we go out to leaps, which are long-term equity anticipation securities. And those are 1 or 2 year call and put options on our favorite and worst stocks to buy. And we often make 100% in 6 months on our leap recommendations. Here's another question. How much do you value intermarket relations? And the answer is, it's actually the most valuable thing out there. When you cover all asset classes, as I do, you have information coming at you from all asset classes, and each one provides insights on all the others. That's why I do this. Most people have equity-only services. They don't have the experience in bonds, commodities, foreign exchange, Bitcoin, precious metals, and real estate. So they're missing those kinds of information to determine market directions. So that's called global long short macro. I've been doing it for 50 years and it works extremely well. Okay, any other questions here? Let me take a look and see what the any more orders have come through. We have Ian from Cambridge, England, it just came through. Thank you very much, Ian, and thank you for staying up this late. It looks like it's midnight or close to it in England right now. We have Seth from New York City. Thank you very much, Seth. Look forward to working from you. Peter from Shreveport, Louisiana has just come in. Thank you very much, Peter. Okay, any more questions coming in? Let me take a look here and do a quick read. Okay. Okay, without any questions, I'm kind of running out of ideas here. David, have you got anything to talk about?
I'm trying to. Do you have any other, stocks or sectors you'd like to talk about?
One thing I've been getting a lot of questions about today is Kathy Wood's ARK fund. And ARK is basically the anti-investment right now. It is perfectly in the wrong place at the wrong time. I expect the ARK fund to drop, another 25 or 50% from these levels, and eventually drop to a level that is as much as 80 or 90% from last year's all-time highs. Non-earning growth companies with great prospects but no profits are exactly what you do not want to be buying right now. So as much as ARK looks cheap, it's just gone from 165 down to 60. don't touch it with a 10-foot pole. There's a final capitulation to come there that could be many months off. And by the way, this sell-off, even though we've had a bad couple of weeks, this could go on for 4, 5, or 6 more months. So I'm looking to sell every rally, and I'm only covering shorts on the dip. There's no real reason to go huge net long down here, especially with the better quality companies. And here's another question: how much, what kind of factors go into your market timing index since it's so successful? We do add a lot of the traditional technical analysis type things like RSIs, moving averages, and so on. But we also have a few of our own special tricks to add into the index, which makes it better than just about anybody else's. And it does have a 90% success rate. We have back tested this 20 years and found it extremely effective in calling the short-term move of the S&P 500. And it's things like our market timing index that give us the confidence to put on a double short on the S&P 500 right when it's doing a double top on the charts, which we could clearly see happening in December. Okay, again, to subscribe to our service, just go to madhedgefundtrader.com/STE35. That will take you to a dedicated sales page, which you can only obtain through this webinar. Okay, let's see if we have, and David has just entered the link again. Okay, any other questions to come? Okay. And we see that Vladimir Putin now has 100,000 troops and heavy weapons on Ukraine's border. Let's see if we have any reaction yet in the Asian futures market. And the answer to that is yes. Dow futures down 83, S&P 500 futures down 13 points. Looks like we're going to get another hammering at the opening tomorrow. And bonds are barely moving. They're still at a 1.77% yield, and they're clearly benefiting from a flight to safety bid, which will go away once the markets bottom out. Okay, any other questions here? Here's another one. What time does your newsletter come out every day? We have both our newsletters, the Mad Hedge Hot Tips and the Mad Hedge Global Trading Dispatch. Hit your inbox before the opening every morning. That way you have plenty of time to enter the orders and get some good prices right after the opening. And again, that's with this service, the six-month, $997 service, you get 10 newsletters a week, which are easy to read. We try to keep them short and to the point. And they're fun to read. Here's another question. Any analysis on crude? Obviously, the major driver of crude is whether Russia invades the Ukraine. Russia is the world's largest exporter, but the second largest exporter after Saudi Arabia. And if the US then boycotts all Russian exports, as they're promising to do, that could create a massive energy shortage, which hits Europe, but not us, since the US is a net energy exporter. So look for literally an overnight move from 80 to 100. And then after that, we'll have to see what happens on the political front. Longer term, I see oil going to zero as it is replaced by alternative energy, solar, and all the other forms of alternatives. 50% of all oil consumption in the United States is from internal combustion engines, and sales of those engines will go to zero by 2030. It's already illegal in a lot of states. So don't look, and certainly Detroit is not investing any more money in the internal combustion engine. All of their new investment is going into electric vehicles. And am I getting into hydrogen and fuel cells? The answer is no. Hydrogen is not scalable to the extent that electric power is. And the new research money going into hydrogen is very limited to a few universities. There are no mass-produced hydrogen vehicles that are economically competitive with the EVs, and EVs are still on an exponential growth rate in the improvement of their technology. So there may be, specific applications for hydrogen in fleet operations, for example, but for the mass market, I just don't see hydrogen ever catching up. And I've been watching hydrogen for 50 years, so it's not like I'm new at this. Okay, well, David, that just about does it for me.
Do you have any thoughts about why Russia keeps escalating this Ukraine situation? Like, what do they think they're going to get out of it?
Or that the standard of living in Russia is awful compared to the standard of living in Europe and the United States. Yep. And the best way Vladimir Putin has to distract people from that reality is by invading other countries. This is not a new strategy. He's already invaded several countries in the old Soviet Union. And in fact, one of his long-term goals is to try and resuscitate the old Soviet Union by invading the individual republics. So this could turn into a real hot war pretty quickly. The US is moving carriers into the Black Sea, so our fighters are within range of a Russian invasion of the Ukraine. And if we bring our fighters in to attack tanks on Ukrainian territory, you will get a repeat of the Iraq war, where we basically wiped out 5,000 tanks with air power with the loss of only one of our own. And the Russians know this. So it's going to be a game of chicken to see who blinks first. I think moving our carriers into the Black Sea will really cause Putin to pause on his most aggressive plans, because he knows that in a one-on-one conflict between the United States and the Soviet Union in a conventional war, it's a complete wipeout. So I actually would kind of like to see that, see them send 1,000 tanks into the Ukraine and just have them go vaporize on a screen instantly. That's what would happen. And in the meantime, I'm still on call as a Marine Corps combat pilot. It's a job you never retire from. So I could be getting my papers soon on this. They need people with local area expertise. I just don't have to be one of those. So who knows? Maybe I'll be back in my Marine Corps flight suit in no time.
It's an interesting situation.
It is. It's a sobering thought, to say the least.
So they got away with Crimea. So you think he's just
and it isn't just Crimea. They've gotten away with every single invasion of the last 10 years. And let's face it, the last president really wasn't tough on Russia as much as deserved, I think. And also letting Europe become completely dependent on Russian energy supplies was never a bad idea. And the US has been against that since the very beginning. And that actually started during the Reagan administration, when the first Russian pipeline was built. Let's see, I got another question here. Let's see. I can see the Russians, their main interest is not so much invading other countries, but maintaining a neutral area on their border. And that is a legitimate concern. The Chinese are the same way. I have a feeling that Putin's going to try and nail down the Biden administration to commitments about forces that sit directly on their borders. That's what this is really all about. And that will be the peaceful resolution to this conflict, that we promise not to station missiles right on their borders. This all happened in the early 60s, by the way, and is what led to the Cuban Missile Crisis, where we blockaded Cuba. Something similar is going on now. It's just the modern form. Okay.
All right, well,
any
we're
other
about out of
questions?
time.
Let's see. Yeah. Okay, David, you just put the link back up there. I see we've had a couple new orders come in. Thank you very much, and I look forward to working with you. So again, thanks for inviting me again, David. It's been fun, and let's stay in touch.
All right, sounds good. Thanks, John.
Okay,
Great presentation.
bye-bye.
Thanks.